Well, hello and welcome. My name is Chris Tanner. I'm the Director of Education here at New Direction Trust Company, and excited because this is actually one of my favorite webinars of the year uh, because it's not often that you get to get advice from a tax attorney, and especially this time of the year. And I always learn a lot myself, and I'm sure that's why a lot of you are tuning in today. I did want to just start out with a little bit of some of the ground rules for today. Hopefully, you can hear us and we cannot hear you. So just so you know, you are muted today and we are going to have some communication today. And wanted to let you know that we're going to use the question feature for questions as they come up. And so with that being said, I have to begin all the webinars with this disclaimer. And the disclaimer is essentially that New Direction Trust, we don't provide investment advice. We don't endorse any products, nor do we endorse any specific investment firms or types of investment. So today, this is really meant to be educational. Please take everything on a surface level, but we absolutely say go back to your financial advisor, your CPA, your trusted advisor when it comes to actually making decisions. And so I think I kind of hit on this earlier, but on the right hand side, and if you came in today and you know you already have some questions, you can start firing away. But on your screen, on the right-hand side, there's just a button that says questions. I will be monitoring those questions, so feel free to type those in. And what I'll do is I will read those out loud so that everybody can hear us. And then we'll let Peter kind of take it from there. And so with that being said, Peter, how you doing today?
Yeah, doing great, doing great. Snowed under, of course. Tax season is very demanding, but at the same time, excited to be here, Chris. This is, I agree, one of my favorite webinars that I tend to do, and I really love the question and answer format. It's a lot of fun.
Yeah, absolutely. And you know, it was kind of surprising. You probably felt this way too, but I looked at the calendar yesterday and I was like, oh my gosh, it's, you know, almost the end of March. We're like, what, 3 weeks and a little bit shy of tax season. So,
Yeah,
um,
you're giving me those like butterfly panic, moments in my stomach, like, oh yeah, we got about 3 weeks.
yeah, no. And so I did want to just say thank you because I know it is a busy time for you and your firm does prepare taxes and actually does returns among other things. And so I was wondering if you could just share a tiny bit about your practice and then also maybe just a few highlights. I know every year there seem to be little tweaks and tax law changes to just kind of get us kicked off.
Yeah, absolutely. I actually purchased a law firm from my former business partner, yes, last year. And so formerly we were known as Long Law Group, and some of the people who are on the call today may know me more as associated with that firm. But Fusion is really just the successor firm to Long Law Group, with Stephanie Long no longer with the firm. So with that said, we do legal, bookkeeping, and tax preparation, tax planning, and tax advice all in-house. The idea behind that branding and kind of fusion is that, a lot of times you get stuck in a referral loop, right? And people aren't talking. So it's like your lawyer doesn't talk to your accountant needs something, but they're not talking to the bookkeeper, and then the bookkeeper gets confused and messes up your books, and then the tax return's not looking right. It's when things aren't moving in step and in sync, it can be very annoying, to say the least.
Yes.
So the idea would be with Fusion that we're bringing all of that together in one house, right? That the professionals are 10 feet away in different offices, whatever it may be, a phone call away if they're working remotely, but we have a working relationship, we're close, and we know and understand and speak the same language.
And that seems to make a lot of sense to me. And I totally get it because I've been in that situation where your people who are helping are just they're spread out, and it's hard to have people communicate, or you're the middle person trying to communicate and not necessarily fluent in the language, so to speak. So that totally makes sense to me.
Yeah, and I think it's important too. Everybody needs to have a seat at the table, right? And I think one thing about attorneys is that sometimes they can really have that ego, right? And so sometimes they need to be the loudest one or the most correct one in the room, right? And part of that I think needs to go away with this idea of fusion. That everybody has a seat at the table. That the bookkeeping is the language that the company is speaking, which is important for the tax, which leads into the legal, right? I mean, all that is important. It's all part of the same spectrum.
Yeah, absolutely. Well, Peter, were there any major updates or just some general things, and this could take an hour by itself, but maybe some of the higher level things that maybe just you're kind of making your clients aware of as we flip the calendar to this
Yeah.
tax season?
Absolutely. I mean, yes, there is actually a lot going on in the tax world. A lot of that has to do with still Tax Cuts and Jobs Acts, and some of that's beginning to phase out. We've had swings in terms of presidents, in terms of Congress, everything. The political parties are changing, kind of the roles. And so we are seeing a lot of changes, actually. Chris, I think you're going to touch a little bit on the Secure Act 2.0, so I won't go much into that. But one thing that I actually did not realize until maybe about a week ago when I was going back through some of the provisions there, is that actually now you can make penalty-free withdrawals from your retirement account to pay for long-term care insurance. And I really didn't know that, but that's a really great boon for a lot of Americans. And if you're worried about, kind of the long-term picture and what your care is going to look like, because frankly, we're living really long lives these days, that can be a really interesting, spend out of your retirement account.
Peter, was that part of Secure 2.0? That is that new or has that been around? Do you know?
Well, I mean, I guess a good question. Maybe 2.0 tweaked that a little bit. But frankly, I guess I wasn't aware if it was around before.
No, that is good to know. And I think I saw somewhere recently that if you're married, the likelihood that one of you, between the two of you will end up in a long-term care, kind of assisted living situations, like in the neighborhood of 50%. Like it's pretty high likelihood that one of you is going to need that. So that's great information.
Mhm.
Uh, Anything else that kind of
Yes.
jumped out at you?
Absolutely. Yeah, I've got about five here that, I kind of thought about. Meals and entertainment, that's like a really consistent question that I get, and what the deductions are. For those of you who don't know, kind of recently and in the wake of COVID and everything, there was a provision that said that if you, it didn't really matter who you took, if you were a business owner, if you took your client, if you took your employee, if you took a prospect, whatever, to a restaurant and then ate in the restaurant. It's not like a DoorDash deal. I mean, you have to actually go to the restaurant and eat there. That then the meal is 100% deductible. And that's a change because typically travel, meals, and entertainment, they have special rules, and meals and entertainment in particular, they typically get capped at 50% deductions. And so what I would say about the new changes in 2023 here is that frankly, it's kind of a mess because the rules have shifted so much. But some of the 100% deduction still actually exists. And to kind of give you a sense of what would qualify, I'll give some examples. Like if you throw a year-end party for your employees, not your clients, but your employees, that would be 100% deductible. If you do like a golf outing for your employees, again, employees, not clients, that would be deductible. And then like a team building, recreational event, that kind of thing, that's deductible. But everything else is going to shift back to 50% deductible.
Interesting.
Yeah, I don't know the logic behind that, if I'm frank. But whatever. I guess they like employees and team building. So now another development, and this may not be exactly 2023 related, but another development is with 1031 exchanges, where you basically are kicking the can down the road on the tax bill if you're selling an investment property and paying the tax later, or maybe not at all if you pass away. One thing you can now do or I guess it's become kind of a popular talking point, is to 1031, rather than replacing the rental property with another rental property, you can replace it with an interest in a Delaware statutory trust or certain oil and gas investments. And so I'm not necessarily saying like get out of the rental game or, 1031 and get into one of these investments. But what I am saying is that typically when you 1031, you identify 3 replacement properties or a handful of replacement properties. And it might be a good idea to identify a Delaware statutory trust or an oil and gas investment as one of those 3, just in case your deal goes south and then you have to scramble to try to get another deal going within the time frames, right? At least you could 1031 into one of these other investments and then kick that tax bill down the road again.
Peter, that's great advice. I have a friend who I'm going to tell what can happen on the negative side. He sold a property, was fully anticipating doing a 1031, and unfortunately just couldn't find that replacement property. And I know there's a window, and I'm not an expert, but the window passed. And not only does the window pass, but he let me know that his funds were like, with this 1031 company, they just sat there and he couldn't do anything with them for 6 months. And he was pretty frustrated, and I think he would have loved to have known about a different option. And of course, now he's going to have a tax bill on top of that.
Yeah. I mean, I would be incredibly frustrated too. And I see that quite often, these 1031s just kind of falling through, and life happens. I mean, deals fall through. I mean, it's whatever. I mean, it's just part of doing business. But at the same time, I think if you can have just one of these backup opportunities identified, then okay, worst case scenario, just stuff it in there, wait another 2 years or whatever, and maybe even 1031 back out of it, right? So, so too bad about your friend, but I mean, it's unfortunate to see those 1031s fall through. Another development, and this one's kind of a big one, is that typically in the past, we've had bonus depreciation. This came out of the Tax Cuts and Jobs Act. And bonus depreciation basically allows you to deduct 100% of new equipment and certain types of property that you place into use. And that's actually beginning to phase out, and it phases out 20% every single year until 2027 when it's totally phased out. So this year, beginning this year, bonus depreciation is actually only 80%. It's no longer 100%. So if you're looking at making large kind of purchases, improvements to properties or whatever it may be, anything that could kind of leverage this bonus depreciation, better to do it sooner versus later from a tax perspective, because that bonus depreciation is going to begin to phase out.
Interesting. And I think I'm just glancing. I think there was a question on that, so we'll. Cool. So I'm glad you hit that.
Good. Well, now here's kind of my last one here, and I'm hoping everybody has had time to put in their questions in the box now, and I'm sure that there's stuff sitting there. But this is kind of a creative idea, and I can't take credit for this because I by no means came up with this, but I came across it and it's just kind of stuck with me as a really interesting idea. So the idea would be that you can build net worth by using depreciable antiques, right? So if you think about, like, if you're running a business and you need furniture or you need a vehicle or something like that, well-selected antiques, right, those can actually increase a lot in value. And so if you buy that and then put it into use in your business, you can depreciate it, or you can even 179 expense it, take the whole cost that year. and you get a nice tax break. But then, rather than having like an IKEA desk that's not going to be worth anything in a year or whatever, you actually have this kind of nice piece of antique furniture that might actually grow in value, right? So just kind of an interesting idea. I've never really thought about that, but really creative.
So basically it gives you more opportunity because of the value for greater depreciation as well. And then you have possibly an asset on top of that.
Absolutely, absolutely, yep. And you
Yeah,
can watch it increase in value while you get the tax break.
no, that totally makes sense. And well, just a reminder that as you have questions, uh, use that question feature on your computer screen. Uh, Click on that little triangle and you're able to type in there. And again, we'll read those questions out loud and we'll get through as many of those as we can. Before we jump in there, I did want to offer just a couple of quick changes and things that came up. Uh, in 2020, at the end of 2020, there was some legislation called Secure Act, and that Secure Act brought with it some definite changes to retirement plans. And since, of course, New Direction Trust is focused almost exclusively on retirement plans, just wanted to make sure to give a couple of updates because there was, they call it sort of Secure Act 2.0, and this was actually just passed at the end of 2022. So some of these changes took effect immediately. Some of these are being phased in, and I'm just going to highlight a few of them because there were actually quite a few changes that came with it. One of them that I just wanted to make sure and share with everybody is in relation to the required minimum distribution. So where you see RMD, we're talking about required minimum distributions. And of course, this is when Uncle Sam says, okay, we've let you put money aside into a tax deferred, a lot of times it's a retirement account, like an IRA, could even be a 401k, but at some point, that's going to be taxed either in your lifetime or if you pass it on to your heirs. And so these ages have changed and it's going to be kind of confusing for a little bit because at one point that age was 70 and a half. And then in 2020, it changed to age 72. And then this year it changed again to 73. And so I just wanted to kind of list this out to let you know that depending on your age, your RMD could kick in at different points, basically. So you can see that, if you were born roughly from 51, and that should be through, that was a mistake on my part, but that should be through 1960. Age 72 is when basically last year, anything prior to 1950, then your RMD is age 72. If you were born from 51 through 59, your RMD age will be 73. And then if you were born 1960 or later, so you're a few years away, that age will go up to 75. So just want to make sure, because those, especially if you were born around 1950, 1951, there might be a little confusion around when do your RMDs kick in and take effect. The other thing that I just wanted to make folks aware of is, and Peter, I don't know if this is a word, but I made this up. I called it the Rothification. The good news is that Congress and the IRS are expanding your opportunities for Roth contributions, but also Roth conversions. And so back in the 1990s, when the Roth IRA came into being, the Roth IRA was the only way that you could put money into a Roth type account. And for those of you that aren't familiar, a Roth account is one where you pay the taxes up front, but then that account can grow potentially tax-free. There are some rules that go with it, and be taken out tax-free. So there are some powerful tax tools that go along with that, and I'm sure Peter works with folks to look at is that a good strategy or not. But basically, it's been expanded. And then So now simple IRAs and SEP IRAs have the possibility of Roth contributions and Roth conversions. I will tell you, be patient, because New Direction Trust, our company, offers simple IRAs. And on January 2nd, I reached out to Human Resources and said, I want to make my contributions as a Roth. And they said, that's great, and we would love to be able to do that, but the custodian isn't quite ready for that. So there's going to be some adjustments because this law passed like at the end of December. So a lot of the financial institutions, they'll need a little time to get this set up and in the system, but just know you have a lot more opportunities to contribute to Roth accounts, and that will probably kick in when those financial companies are able to handle those accounts. Another interesting change, and this piqued my interest because I have 4 kids in college, and all of those kids have 529 plans. And a 529, think of it as a college savings account. This is money you put into an account, and it's really, its intent is to pay for college expenses or higher education. It doesn't always necessarily have to be college. But a change happened with the Secure Act 2.0, where they will allow unused monies from a 529 to be moved into a Roth IRA. And I just want to point out that there are some rules to be aware of. I'm not going to go into those unless people are really wanting to dig in deep, but there is a maximum that you can move into a Roth IRA. And I think the idea here, if Peter, you can chime in, is that sometimes you maybe put money aside in a 529 and the child decided, I don't want to go to college. So here's this money sitting there, and what do we do with it?
Yeah, that's exactly right, Chris. I've seen, that they don't want to go to college, or maybe they get scholarships, right?
Yeah.
And then it's like, well, great, but now we have all this money sitting here, and then, or they go to a state school or something, and the tuition is just so low that, they've over saved, and then yeah, it's too bad because you wind up with, it's almost like a early withdrawal out of an IRA, right? You pay tax and there's a penalty, and the penalty's not anything to sneeze at either. And so I think this is great. When I found this out, Chris, I'm right there with you. I think it's such a great idea because it really incentivizes the savings. And then, sure, if you don't wind up using it, well, throw it into retirement, right? I mean, why not?
Yeah, absolutely. And I read an article recently, and it was actually a very interesting strategy where, if financing college is not an issue and you have 529 money sitting there, just because Roth IRAs have more flexibility in terms of how you can invest it and what the rules are about how you can use those funds, they said even if you were planning to use that 529 money, it might be a good strategy to move the 529 money into the Roth, as much as you can, just to give yourself a little more flexibility, because the 529, they just don't have quite as much flexibility as the Roth. And it's a nice way to start a kid out with the savings plan. But just want to make people aware of that because I thought that was kind of a neat one. And this is not necessarily, the last one's not necessarily part of Secure Act 2.0, but I wanted to make everyone aware that in 2023, all the retirement plans, and I haven't seen this for as long as I've been in this industry, which is more than a decade, but you name it, IRAs, 401ks, the contribution limits, and I think this has a lot to do maybe with inflation, but they all went up. I wasn't going to cover all the increases, but just let you know that there are some significant bumps. And so the first time in years, I think the IRAs actually had a bump in what you can put aside. So just be aware that there are some higher limits there. And Peter, if people are wanting to put money into a retirement account for 2022, what's
Hmm.
the deadline or some of the rules around that?
Yeah, it's typically tied to your due date. So the tax paid due date. So April 18th would be typically your kind of cutoff point for that. And then if you go on extension, there's the potential you can put it in later.
Okay. So you still have time is basically the takeaway. So April 18th for those IRA accounts. And by all means, if you haven't made that 2022 contribution, we're able to take those on. It's interesting, Peter. I think we addressed this. So the very first question out of the box was the 100% depreciation, and this might possibly
Yep.
be a little different. So I'm going to read it, and if you already hit on it, maybe just a quick reminder. But it said 100% depreciation on my MF syndication, and I don't. You maybe know what that is. Over,
Multifamily syndication.
got it. Uh, over a projected 5-year hold, and syndication sold out in 17. So I'm not 100% clear what that question is, but maybe 100% depreciation on multifamily syndication, if that makes any sense to you.
100% depreciation on a multifamily syndication, but it sold out in 2017. I guess I'm not sure what the relevance of the selling out in 2017, maybe what that's referring to, but yeah, I don't know. Maybe we could get a little bit more information in the box
Yeah.
about that one. I'm not sure where to start with that. I will say, Chris, really quick, Rothification, I love that word. I really do. I'm going to steal it.
Yeah, no, that's great. I was happy to see that. I think it just gives us more opportunities if that's a good fit for your tax strategy. Different ways
Absolutely.
to do that, and it gives us some more strategies. So the next question, Peter, is how do you handle a 1099 DIV? So I think that's dividends, or 1099 INT from a brokerage account of an IRA checkbook LLC. So the LLC is within a self-directed IRA. How are 1099s handled by the CPA? And so I'll paint the
Yeah.
picture here and then let you answer. But here we have an LLC, and it's owned, or the member of the LLC is an IRA. And so this LLC is getting 1099s basically. And so how do they handle those 1099s that go to that LLC?
Yeah, that's a very good question. It also potentially opens a whole can of worms, which I think last year, I think when we did this, Chris, we had a lot of questions when we opened that can of worms. But no, I essentially, because the 1099B and the 1099 INT represent kind of like passive portfolio income, is maybe how I would like describe it, because it more or less is what you would get if you were kind of more traditionally invested, say in the stock market, regardless of the LLC structure and all of that. You don't really need to worry about reporting it, because it more or less is just like the IRA is invested directly into the stocks, bonds, or CDs, or whatever's generating that interest. So the underlying LLC structure with the IRA, really it can be disregarded, and where you have a single member LLC where the IRA is that single member, it's actually called a disregarded entity. So the LLC doesn't need to file any return whatsoever, and then you have the IRA. The IRA typically doesn't need to file any return whatsoever. So you have your 1099 INT and 1099B reporting everything, but then it doesn't really go anywhere, which seems a little odd. It seems, kind of like not the right answer, but that's really kind of how it works. Now, there is a caveat with that, and this kind of gets into the can of worms, but I'm sure we'll get there. Somebody will ask the question, but if you are taking out debt to make any of those investments, then the IRA actually would have to file a tax return. It's a special tax return called a 990T.
Yep, and that's a good point. And the other time is, maybe you can help just paint a picture here, because in this situation it's passive income. But if by chance it was more active income, and I'll give an example. Let's say somebody did a fix and flip and they got a W-9 and the real estate property was bought and sold in less than a year. And because it was less than a year, the IRS might view that as more of an active kind of business income. That would kind of change things too, right?
Chris, you know your stuff. Yep, all the details were there. Um, so this is kind of the can of worms I was dancing around, but we'll just directly open it. So if you have a 990, if you have an IRA and the IRA takes out debt to make investments, or as Chris kind of put it, it's kind of like an active business, right? And so you're producing really what might be subject to self-employment tax, but yeah, like you're doing fix and flips, you're operating a business. There's various ways you can trigger that, but you would actually have to file that same return, the 990T, because it's what they call unrelated business income. And basically what that means is that you're running an active trade or business activity, and that's not related to kind of the retirement goal of the IRA. So yeah, I think typically the biggest places where you run into this would be somebody doing fix and flips inside their IRA. That would generate the need to report that unrelated business income tax. The other way you see it is somebody buys a rental and they get a non-recourse loan, and they put down a 20% down payment, finance 80% of the purchase, and then now we have debt financed income, and both of those have to be reported on that special tax return. So circling clear back, where you have, like a 1099 INT or a 1099B, where it's kind of this passive, okay, we're investing in the stock market or CDs or something like that. That's okay. That's kind of that traditional IRA type investment. And so there's really not any reporting that needs to be done there other than, Chris, I think you guys take care of this, but the annual valuation reporting, right?
Yep. Yeah,
Yeah, and then where you have this other type, then the 990T. So
yep, exactly. Yeah, we file, it's called a 5498. So whether you know that or not, all custodians of IRAs must file that form where we're reporting the value of the account to the IRS. So thank you, great answer. And so the next
it was
question, and
long-winded, but yeah.
it was, but I think what it highlights is the idea that you can get into some interesting investments, and it is important to have a good tax advisor who can look at your situation and give you good advice. And I can say Peter is unique in that he has a breadth of knowledge that's not common. I'll just say it that way. Okay, so the next question, it says, I understand that passive losses don't count against active participation income. So how does bonus depreciation loss help in an LP investment? And so that's like part one. And the next part of this is depreciation different than other types of losses? So it's kind of a two-part question there.
Yeah. Yeah, that's those are actually interesting questions, and again, I think the first question, it shows a good level of understanding of the tax code actually. So hats off to you, for that aspect of it. So I mean, I think that what I would say is that so. I guess my mind is reeling kind of with the possibilities. So with 100% bonus depreciation, the idea would be, right, and maybe I'll back up and kind of explain a little bit for everybody, but it's like if you purchase, let's say like a air conditioner or something like that, and it costs, we'll say $5,000. And so then, normally what you might have to do would be depreciate that over its depreciable life. Now, offhand, I'm going to say an air conditioner is probably 5 years. It could be 7 years. I would have to look. But either way, the idea would be that we would recover the cost or deduct the cost of that air conditioner, but we would spread it out over 5 years and you'd take just a portion each year. But with 100% bonus depreciation, instead of taking it over 5 years, you can just deduct the full cost in the first year, right? That's the 100%. Now it's 80%, right? Kind of like I mentioned. So you're right. To the extent that you're passive in we'll say like a partnership or maybe even an S Corp, this is not a C corporation because that answer would be different. But a partnership and an S corporation are unique because they don't actually pay tax at their level. What they do is they pass all the tax attributes out to the business partners on a Schedule K-1. And so you'll have these kind of tax attributes. One of them may be passive income, passive loss. And so you're right. 100% bonus depreciation, what it will do is on your K1, increase the amount of your passive loss. And so then when you go to your 1040, your personal tax return, and then you input all of those numbers and all of the tax attributes onto your 1040, you're right. Passive income, really, you're limited in how much you can use against your active income. If you have only passive loss and then active income like a W-2 or something like that, you're limited to $3,000, and then you just carry it forward year after year and just slowly use it up. And so the 100% bonus depreciation is going to increase the amount of the passive loss, but then you may still run into that $3,000 limit, right? So what you can do to free that up would be increase passive income, right? To the extent that you can get into a new investment, increase passive income, maybe put off large capital expenditures in other investments or things like that, increase passive income to take the full amount of the passive loss. That may be a way to free those up. So that's a really complicated question, but that's the answer there. Depreciation is different from other deductions. We'll get to that question now. Depreciation is different from other deductions because it's really more just like I refer to it as a paper loss. It doesn't really impact your cash flow or anything like that. So let's take an example of a rental property. You depreciate a rental property over 27.5 years. And so every single year you're taking a small amount of depreciation, or if it's a commercial property, 39 years, but your depreciation is going to be larger because your purchase price is larger. But I've seen depreciation deductions as much as, I've seen really large ones, but I've also seen them as large as, say, $20,000, right, on a property. Well, you're basically offsetting $20,000 of the income, the rental income on that property, but you're not out of pocket that $20,000, right? You didn't actually spend it. So it's different than other deductions because really it's more like a paper loss or like a paper deduction, and your cash flow is very different because you're not actually out of pocket that expense.
No, that's a great explanation, and that is one of the benefits, right, of real estate, is that you do have the opportunity to take that depreciation, and sometimes it's accelerated, or there's certain things you can accelerate that help offset whatever rental income or other income you're generating. That's outstanding. So
absolutely, yep, that's exactly right.
Okay, so the next question is asking, in 2022, I bought a home with a bridge loan, moved, sold my departing home, paid off the loan. Can I deduct the very high brokerage fee in 2022?
That's interesting. The brokerage fee, I presume, was paid on the bridge loan.
Yeah, that's what I'm wondering, because when I hear the word brokerage, that says real estate agent, but I'm wondering if they're talking about the loan originator,
right?
Like fees associated. Maybe we differentiate that way.
Yeah. Well, and I guess maybe I can answer it both ways. I mean, to the extent that it is a brokerage fee, I would deduct it. I guess the question would be where I would deduct it. And that actually goes into the second one, which would be, okay, it's some kind of loan fee or something that you're paying. And so the question again would be, okay, where would you deduct it? And the resounding answer would be, well, it'd have to go on Schedule A, which is your itemized deductions. And itemized deductions are really interesting now. The reason being that the standard deduction, so to back up, you on your tax return, what you do is you report all of your income, and then you take out some adjustments, and adjustments are kind of like supercharged deductions. So you have HSA contributions, some other things there, IRA. No, just sorry, it trashed that. But HSA, some other things that will adjust that number. Then you get to your adjusted gross income. But then from that number, then you take your deductions. And so you can either take the standard deduction, which Congress just says, okay, everybody in the United States gets this number as a deduction. And so like if you're single, it's 12,950 in 2022. If you're married, filing joint is 25,900. So you can take that standard number, or you can itemize your deductions. And so if your deductions are higher than 25,900, then, okay, there's the potential you could itemize out these deductions. So to answer this question, you kind of have to say, well, are you taking the standard deduction, or are you itemizing your deductions? Because if your other deductions are such that you're never going to break over, say, that 25,900 number, then you're not really going to be deducting that amount, period, because you're just going to be taking that standard deduction. If, on the other hand, you are itemizing, then, yeah, we could maybe throw it in, somehow into the home mortgage interest deduction or something along those lines. I'd have to really sit down and chew on that. It's a good question, but that's where it would be, and you'd have to itemize to even take advantage of it.
Yeah, no, and I think that's a good explanation. And again, that's the importance of a good tax advisor, because to your point, Peter, it really depends on your situation in the year that that happened, whether it's useful or not. So that totally makes sense.
Yeah.
So I did get a question here asking about where you would recommend investing. Unfortunately, we don't do any kind of investment advice. So that's a question I'm gonna say we just can't answer. Just because we're not a broker, we don't have securities licenses, and so just as a reminder, we don't offer any advice as far as what to invest in. So the next question, Peter is asking, if one passes away with tax obligations, are the beneficiaries responsible for their uh, retirement accounts? And so I guess so maybe there's some tax obligations and they inherit. There might be a couple of answers here, but they inherit those accounts. There could be a pre-tax and a Roth IRA, but maybe address when someone passes away, if there's some debt outstanding, what does that look like for the heirs? And does it
Sure.
impact those retirement accounts that they inherit?
Yeah, I was with you all the way until the retirement accounts. Then I got a little confused. And there is, inherited IRAs and things. Chris, you probably know a lot more about that than I do. So I won't really get into that area, in this explanation. But, typically what happens, so you pass away, and then your beneficiaries, what they're going to do is all come to the table. And, if you have a will, then your personal representative is the same as an executor, if you're familiar with that term. But in Colorado, we just call them a personal representative. But your personal representative is in charge of what they call marshaling the estate, which is, okay, gathering everything that you owned, figuring out all the assets, and then figuring out all the liabilities, right? And so if there is debt owed, or a tax liability, and then the IRS has a lien on you, or something like that, as part of settling out the estate, the personal representative may sell off certain assets to pay that debt, right? Now, to the extent that the debt may like be larger than the than the assets in the estate, it just kind of dies there, right? I mean, the beneficiaries really aren't on the hook for the overage, so to speak. That said, IRAs are a little bit different, right? Because they're protected, typically have good protections under state law and those kind of things. But that said, I don't really know how, if they were to elect to put it into an inherited IRA, I'll be honest, I don't really know how that would impact, paying off debt. But typically when an IRA owner passes away, they have a beneficiary designation on the IRA. And that says, okay, pay out to this person, right? And so to the extent that it would come out of that IRA, the funds would come out of that IRA, I would think that those would be attachable, that whoever is owed the money could reach that money before it were paid to the beneficiary.
Yeah, and I'll follow up just a little bit on that. So IRAs generally are protected from creditors, and it is based on state law. So every state typically has a threshold, but it's usually a pretty good sized threshold. Like it's usually in the neighborhood of like $1 million. So that IRA typically is protected up to a threshold. The one thing I wanted to mention, because this is important, is one of the ways that creditors can go after IRA plans is if they think there was been a prohibited transaction. And so this is one of those, I'm not going to use the word sneaky, but this is one of the ways that if a creditor is really sharp and understands the tax laws, if there was ever a prohibited transaction in an IRA, what that means is that that IRA would be considered a distribution at that time. And so even if it occurred in the past somewhere, we've heard of cases where creditors can go after the IRA because technically it was distributed. And so that's why, and the only reason I mention that is that we're in the business to make sure that with especially the kind of investments our clients are involved in, that you just have to really be careful. Make sure you are aware of those prohibited transaction rules, because it has weird ways that it could come back and get you. So this prohibited transaction could have gone undetected and maybe not even, never brought up in an audit or anything like that, but a smart creditor down the line understands that they could possibly go after those funds. That's why you just stay on the correct side of those prohibited transactions, because the consequences they're tough. I'll just say that.
Yeah, I'm
Uh,
totally shaking my head over here, Chris. That's a really good answer. I didn't think about the prohibited transactions and just that you couldn't even argue it's an IRA anymore, so it just sidesteps the whole protections that the state legislature gave you. Interesting.
yes,
Yeah.
yes, and the only reason I brought that up is because we saw a court case. Basically, it was in bankruptcy court, and granted, the person that was representing the debtor, or the creditor I should say, was sharp and kind of understood these rules. Anyway, just FYI. This next one, this is a good question. So we talked earlier, Peter, about the 529 to Roth, the ability that you could do like a rollover. And the question is who does the rollover go to? Is it the owner of the 529 or the beneficiary?
That is a very good question. I think so one thing that's interesting about a 529 is that it can kind of, even though I agree with what you said, Chris, that the 529s tend to be a little more rigid, right? And a lot less flexible than the Roth IRA. But yeah, one thing that's interesting is that what happens if kids don't go to college, then what happens next, right? And who benefits and who pays and those kind of things. But at any rate, with the Roth IRA conversion, I actually don't know the answer to this for sure, but I would think it needs to be in a Roth IRA for the beneficiary, that essentially once you've put money into that 529 plan, you've made more or less a completed gift, right? That now those funds belong to the beneficiary.
Yeah, and I would agree with that because those funds are intended for the beneficiary. And this really comes into play because normally a lot of times the beneficiary is a minor, and I would agree with that assessment that it would go to the beneficiary. And I'll just one other quick thing to be aware of is that there are some deeper rules about this rollover from the 529 to this Roth IRA. So one of them is that the beneficiary actually has to have some earned income. And so if you have, an 18-year-old that hasn't worked at all, the rollover is not possible because the IRS says that they have to have some earned income in order to do the rollover. And so just be aware that there are some additional rules around that. It's not a slam dunk, like you can just do it. Just be aware there are some additional rules around that. The next one, this is actually an interesting question, Peter. And the question is, and I bet you could go deeper with this, but what is the best age to do a tax deferred? So maybe it's a traditional IRA, or maybe it's a traditional 401k, it's a tax deferred account, and do a Roth IRA conversion. And this is a deeper question, I think.
This is absolutely a deeper question. Holy cow. Yeah, and this to me actually kind of gets back. You're right, Chris. It's a great, interesting question, and this to me gets back to kind of what I was talking about with the whole concept of fusion, because I feel like a voice that needs to be at that table is a financial planner or wealth planner, right? Because you have to look at that big picture and say, what does retirement look like? How much do you need? What is your retirement age? And then back to what Chris was talking about, if you are going to be subject to RMDs, then okay, when are you going to take those, and how much of a tax bite are you going to see out of those, and then how does that impact your retirement age and things like that? I mean, there's just so many moving parts to this that there needs to be a lot of voices at the table, I think. But at the same time, kind of concretely what I would say to answer this question, and if I were the only voice in the room, typically you will want to do a Roth conversion in a year where you have less income. And the reason is because basically you have to pick up the amount that you're converting into your income and pay tax on it. So if you're bumping up against like a higher tax bracket, and then you were to take or do a conversion, you could actually bump yourself into that next tax bracket, right? And so to the extent that you're in like your highest earning income years, you probably don't want to look at a Roth conversion those years, because it's just going to be really expensive to do, relatively speaking. Then, if you waited until maybe when you were semi-retired or working less hours, or, whatever it is, your income drops a little bit. Now, it may be harder to pay the tax bill because you have less income, right? But relatively speaking, the tax rate that's going to apply to that conversion, that's going to be a lot more friendly.
Yeah, and if you don't mind, I'm going to throw in a little extra piece here.
Please do.
And the extra piece I'm going to throw in is that we have tax brackets right now, and maybe you can correct me if I'm wrong, Peter, but I want to say they're kind of set to expire in 2026.
Yes.
So the current tax brackets, here's the only reason I'm mentioning this, is that I think we have a window here that the IRS gave us, and I'm going to focus on the middle tax bracket. I happen to have this in front of me. The middle kind of tax bracket is sort of that 22 and 24% tax bracket. And right now, like if you're married filing jointly, just to give you an idea, you're kind of talking about 90,000 up to like 360,000. And the tax, if they don't change anything, that bracket's going to revert back to what it was. I think, this was I'll use Trump's tax bill that came in, and I don't know the timing of it, but that middle tax bracket's going to shrink quite a bit unless they keep it the way it is, but it's set to expire. And I only point that out to say that they really expanded that middle bracket so that you could collect, that 24% tax is not brutal or horrible, but that one's going to shrink unless they maintain the brackets. And so just something to be aware of in the future, because it might be, if you're kind of in those higher brackets, the opportunity will go away and the higher tax might kick in. Hopefully that
Yeah.
makes sense.
No, that's a really nuanced point. That's a great point, Chris.
Okay, so the next question, I'm excited to hear your answer on this. This is kind of the nerdy me geeking out here, but so if somebody is in a UBIT situation, so maybe they do have leverage on a real estate property, but at the end of the tax year and they don't actually have to file the 990T because they didn't have enough income. I think the question that's being asked here is, let's say I didn't hit that threshold of, making $1,000 of net income. Should I
Uh-huh.
still file that 1099? Because obviously there's a cost to filing it. Kind of what would you advise somebody in that situation?
Yeah. I mean, yes, once again, good question. There are a few moving parts to this, in the sense that the calculations on the return, they start with like year beginning numbers and year end numbers. And so if you have debt at the beginning of the year, but then you pay it off over the year, so you end with no debt, you still do apply a percentage to the income, to get to your unrelated business income tax. And so there's the potential there, like even if you were to pay off the loan or no longer have UBIT or something, that you would bump over the $1,000 specific deduction that Chris mentioned. Very good. But yeah, to the extent that you don't, right, that you're sure that you're just going to have a zero tax liability on that 990T. I think if it were me personally, I would just not file. I wouldn't worry about it. I would look at the state and make sure that the state doesn't take away that $1,000 specific deduction or do it in some certain way. And by the way, some custodians, when I prepare the 990Ts, are surprised that I do states because they didn't even know that states were a thing, but they are in fact a thing. You have to file a state return as well, in a lot of states, not in every state. But at any rate, sometimes the state treatment can be different. So I would make sure first off that there's just absolutely zero tax liability whatsoever. But that said, that's probably not the best way to approach it, even though that's the way I probably would do it if it were my IRA. But the best way to approach it, and I actually do this for some of my clients, is we go ahead and file, and we may file a zero return if in fact it's a zero return. But to the extent that you actually have some deductions or other maybe even depreciation can be a thing on these 990Ts. To the extent that you might actually generate a loss, it might be useful still to file that 990T, right, and log that loss, because then that'll carry forward year over year. And then when you do have the unrelated business income, you have the loss there to offset it.
Yeah, that makes sense. And if you, for whatever reason, maybe you had a property, you had a lot of work that you had to do, and so you actually had a lot of expense, it might be nice to capture those expenses to offset future income. I like that. That does make sense.
Yeah, I think it's the really correct answer, right? But also it requires the cost and the effort of the return, right?
Right. Absolutely. This is actually an interesting question. This next one is kind of asking about, do I have to do a 1099? So this person's asking, like, I think kind of the example is maybe they own property like in an IRA, and this might even apply outside of an IRA, I don't know. But if there's a service provider, so maybe I'm just off the top of my head, like a property manager
Sure.
and something like that, you're paying them more than the $600. I think 600's the threshold for these
Yeah, it is.
1099s.
Yep.
Like, how do we know who gets a 1099, who doesn't get a 1099? Maybe a little clarity, like, and this is just kind of opens maybe a can of worms, but I have confusion on this myself.
Yeah, it's a moving target in the
Yeah.
sense that like you have a rule, then there's exceptions to the rules, and then there's exceptions to the exceptions to the rules. So I think when I heard 1099, I just assumed that we were talking 990T. But going back to 1099, yeah, if there is a service provider, contractor, whatever it might be, and you do pay them more than 600, or the IRA more correctly pays them 600 or more, I still would issue that 1099. I think that that's the default position, that you would have to issue the 1099. And the reason is because the IRS otherwise cannot police any of the contract labor. They won't know who was paid what, who has to pick up what in their income, pay tax on it without the 1099. So I think that's always the default rule. If you pay more than $600 to somebody, you have to issue them the 1099. Now that said, there's exceptions, right? So you actually would give the service provider a W-9, and the W-9 has a spot for them to fill out their name and then fill out how they're taxed. So there's actually boxes they can check. It says individual or single member LLC, partnership, S corporation, C corporation, trust, whatever it might be, but they can check the box. And then there's a spot for their social security number or their employer identification number. And that's all the information that you need to issue the 1099. So I advise people, right, like at the beginning of the relationship, give them the W-9, or as soon as you're going to pay them $600, give them the W-9, because they're not going to fill it out, 3-4 months later, right?
Right.
So anyways, I would have the IRA issue a 1099. But that said, corporations don't need to receive 1099s. So if you get back the W-9 and they've checked the box for C corporation or S corporation, you don't have to give them a 1099. Except for, this is the exception to the exception, except for doctors and lawyers. Because doctors and lawyers are always really aggressive on their taxes. They're up to no good. The IRS always polices them extra carefully. And so if they're doctors or lawyers and they're an S corporation or a C corporation, they still have to get a 1099.
That was a fantastic answer, and I thank you for the clarification, the difference between an individual and someone that's has a corporate entity. That's a great distinction. Um, Peter, this has been flying by, and it's 1:04 by my clock. And I know when we talked earlier, we said maybe around 1:10 would kind of be a hard stop, because I know you have a lot of deadlines. I just want to let people know we have about 5 minutes to go. And if you didn't get a question answered, and if you did want to follow up with Peter, or you're interested in Fusion and their services, give Peter, please, until like May 1st. Is that fair, Peter?
Absolutely fair, yeah.
Okay. But please do reach out, because you're a wealth of knowledge, Peter, and I think you have a unique practice. By all means, follow up with Peter with some of these questions, or if you're interested in his services. If you have more IRA related questions, I would encourage you to contact us directly at New Direction Trust. We're happy to answer those questions, but things that are more on the tax legal side, by all means, connect with Peter. Let me jump in here. I'm going to answer one super fast. This one says, I understand that if you do not have to take RMDs from a 401k if you're still working, how about a SEP IRA if still working? If you don't mind, Peter, I'm just going to jump in on that one.
Oh, please, yeah.
So if you're of required minimum distribution age, and if you're working you're still at an employer, and this is the key thing, their plan has to very explicitly state there's what's known as a still working rule, and it has to be in their plan document. This isn't automatic, but if it is in their plan document, you can delay RMDs from the 401k while you're still working. That does not apply to IRAs. So the flavor of IRA does not matter. It could be a Roth, but take that back. Roths are not, scratch that. Traditional IRAs, simple IRAs, SEP IRAs, it would not apply. So I'll hit that one super fast. Okay, here's our guy coming back, our very first question, Peter, and I'm
Good,
glad
yeah.
and this might be our last one, but it says, sorry for the confusion, but here it is. He says, my 5-year bonus depreciation syndication sold out in 17 months, resulting in about a 35% loss on a K1. Do I still have 65%? I guess he's talking about that bonus depreciation to use. Can he carry that forward?
Yeah, that's interesting, because typically what jumps to mind is depreciation recapture. And so I guess it's very complicated. I'd have to take a look at the return as well as the K1. But what I would recommend is I'm going to guess it's a partnership, should be. And then let me take a look at the K1 really quick. I just have my software up here. I can let you know if in fact you have the K1, whether this happened or not. It would be in box 9C, where it lists out unrecaptured 1250 gain. Basically, the idea behind recapture, and some people trigger this without even really realizing what they're doing, but the idea is because you would typically depreciate something over 5 years, you have your depreciation number. Every single year it should be under the normal like maker's depreciation system, a certain dollar figure. But then in year one, if you take 100% bonus depreciation, you've taken like extra depreciation the other 4 years in that first year. And so the way that Congress approaches that is they say, well, look, in that year that you took 100% bonus depreciation, you got a tax benefit that you really weren't entitled to because later you sold it, right? And I
Yeah.
understand it's the syndication, not you personally, but the idea is that the amount of the deduction over what you should have taken in year one under the typical maker's system, you have to pick that back up and pay tax on it because it's a benefit that you weren't allowed to take, right? Because you sold it. So that's depreciation recapture in a nutshell. And where it would show up is box 9C on the K1. I'd be interested to see if maybe the partnership passed out that depreciation recapture to you, and then you have a small tax bill as a result of that.
Wow. That was a really detailed, that was amazing, Peter. Okay, Peter,
Thanks.
you let me know. It is 1:10. I know you're busy. If we're at a good stopping point,
Yeah.
we'll cut it
Well,
down, or it's up, you let
yeah.
us know.
How many more? Do we have a lot of questions left?
Um,
I could
we
maybe
do.
go another 5 minutes is what I'm thinking, Chris.
Okay,
Yeah.
we have a few. Uh,
All right.
I'm
All right. Let's go another 5 minutes, but then we'll stop
okay.
there.
I'm gonna this next one I'm gonna answer super quick just because for time's sake. The question is there currently any proposed legislative changes to 1031 exchanges? The short answer is no. I think the reason this came up is at the end of 2021. This has been a little while ago. There was some proposed, that's the key word, proposed legislation that maybe would have modified that. It died. It didn't go anywhere. And nothing's really resurfaced since then. So I'll just really quickly on that. Let's see. Okay, so this question is asking, is it possible to convert a traditional IRA invested in real estate to a Roth IRA? And if it is possible, how do you account for taxes due? So we're basically asking, instead of converting cash, can we convert an actual holding or an asset?
Yeah. Well, Chris, you probably have seen this a lot more than I have, but my answer would be sure. Why not? But I think there's issues here, right? And that would be valuation. I think would be your biggest issue. Because essentially what we're doing is taking the entire account or a really large potential asset, right? And if you were to take a similar like cash value of like stock or something that you've invested in, right? That's going to be a pretty significant chunk that you're going to have to pay taxes on. And I think the IRS would be very interested in how you valued it, right? Because that ultimately then
100%.
impacts the amount of tax that you've paid, right? And so, probably an appraisal is the best thing to do, but that's of course a little expensive, but that's probably the gold standard. Chris, would you add anything?
You really hit the nail on the head. And so you absolutely can do this. And we won't get into the logistics. This would be a question. Come, please ask us, like, how does it work, like titling and all that. We can help you with that. The number one thing, and Peter nailed it, is this is not a time to go on the internet and get a number from Zillow as this the value of a property. This is absolutely, you want an appraisal. That's the gold standard, because if the IRS ever came back and said, how did you come to this value for this property? We don't want your brother who's a real estate agent. We don't want anyone who's related to you. We don't want any appearance of any kind of wink wink kind of deals, like where you're trying to intentionally have a lower value. If you're really wanting to do this, just pay for the appraisal. And I am with you, Peter. It's the gold standard. So there's really no question. It's an unbiased opinion from a professional that's their job. That's what they do. The IRS isn't going to argue with an unbiased appraisal. And that's really the critical issue. Once you get that done, we can help you with the pieces as far as how does the actual titling and all that stuff work. We can definitely help you with that. Let's call this next one our last one, Peter, and thank you. You've been very gracious with your time. And this question is asking, we have several separate accounts at First Bank for LLCs that own real estate properties that are structured to have rental income through one parent LLC. The LLCs are 100% owned by a Roth solo 401k. We'd like to be able to, boy, this is this is like a long one. Bear with me. So we would like to be able to transfer the accruing liquid funds from the parent LLC into a liquid money market account at another institution to earn some interest, diversify into some funds in an additional bank, as long as any of the unseasoned Roth funds are accessed. Is there any issue to having the funds earn interest in a money market account from the IRS perspective? That's a long question. Hopefully you followed along with that.
I think I did.
Okay.
I mean, probably a good idea even from an FDIC standpoint, right? Just, I don't know how much money we're talking about here, but with, multiple rental properties, and if it's really been accumulating, getting some money over into another institution probably isn't a bad idea. Of course, on my mind because of all the bank meltdown
Yeah.
recently.
Yeah.
But at the same time, I guess, so this is maybe where I hope I followed everything correctly, but the money market account, essentially what it sounds like to me is we're going to sweep money out of the bank where the LLC accounts are over into another account or over into another bank with a money market account, whatever, maybe a brokerage with a money market account.
Yep.
And to the extent that that money market account is owned by the IRA, I don't see an issue there because it still remains qualified funds, right? Now, the fact
Yep.
that it's, unseasoned Roth or anything along those lines, because you're not personally touching it, it's not in your name. It's not, the account is not yours, it's the IRA's account. I still think that that's fine. Really, all we're doing is just sweeping money into a different type of investment or a different type of account.
Yeah, and I would concur. And what I would say also is it was a long question, and by all means, if you want to send that our direction, by our I mean new direction, our general email is info at ndtco.com. Please send that along. But Peter's spot on. If it's staying under the guise of the IRA and the account's opened as an IRA account, there's absolutely nothing wrong with moving funds from one IRA to another Roth IRA. And if you're taking it out in personal, then it's a little bit deeper question because your age could come into play, and then it's what type of funds, were they contributed funds? So there are some rules around those Roth accounts, but I could dig in and look at the specifics if needed. But I think that's a great answer. So Peter, I think we could probably go till 5 o'clock, but we've hit the
Yeah,
wall.
I am going to get on more tax returns. Yeah, I desperately need to keep moving. So, Chris, I really appreciate the opportunity to do this. Like I said, it really is one of my favorite webinars I do. You know, it's always nice to work with you and collaborate with you.
Yeah, and thank you, Peter. Wonderful to have a tax attorney available to answer some of these questions, and appreciate you donating your time. Everybody, thank you. Hopefully you get everything squared away by April 18th or file those extensions. But if you do have questions for Peter, please do reach out. This recording will be available. That will come out tomorrow. So you can get contact information or kind of review some of those question answers. There's some pretty gnarly ones there. But I want to thank everyone for tuning in, and look forward to connecting with you in the future. Everyone take care.